Welcome everyone to Vested Interest. This is Shane. Today we are going to cover the portfolio update for the past week. A lot of activity in the portfolio this week. We did add $1,398 in new capital to the portfolio. We also sold out of two positions. One of them you might be aware of, Intel. They dropped their dividends, so one of the things I had said earlier whenever I chose to keep them in the portfolio was I was with them as long as they kept the dividend stable. The last report out they had given, they said they wanted to leave it as it was or even grow it over time. Obviously, that is not the case, and it was a significant drop by 2/3, so that definitely changes some things. So we sold out of that position as well as one other, we'll see here in a moment, and we reallocated those funds throughout the portfolio, and you will see all of that in this update. Before we get into the video, I'd like to take a moment to thank everyone who's taken the time to watch, who's taken the time to watch, like the videos, and subscribed to the channel. Really do appreciate all of you out there who have already subscribed, and if you have not already subscribed, hit that subscribe button down below and join me on this journey to financial freedom. There's also a Webull link down below. If you have not started your own journey, you can use that link, deposit some money in there, start your brokerage account with them, and you'll get some free stocks. I'll get some free stocks. It is a way to help out the channel. But hitting that thumbs up if you find value in the content helps out as well. Dropping a comment, like I said, and hit that subscribe button so you're notified, or the notification bell so you're notified whenever we post any new videos. So let's jump into the video. We will start off with any dividends paid out for the week, and then we'll get into the activity, new buys, the reallocation, everything associated with the portfolio. So this week we did not have any dividends paid out, so that's going to be a quick one there. We will jump over the first sell out of the portfolio. Huntington Bancshares, I sold out of this position entirely. There are a couple other banks right now that I want to focus on more than Huntington Bancshares. Not that it's a bad company. It was the slowest growth in the portfolio as far as the financial sector. The others that I left in are growing much faster and are actually down. This one was actually up a little bit, so I did book a little bit of profit here, which was offset by another sell. Whenever you see Intel, that one was down a little bit, pretty much flat between those two sells, but it did amount to $2,660.11 reallocated, but it also removed $110.36 in passive income. So that is part of the problem with selling out of a position. Whenever you sell out, you have to reallocate to capture back this passive income that you've just lost, right? So that is what we try to do, and we'll see that here in a moment. And as you can see, the $2,660.11 that we got from selling out of Huntington Bancshares, this is where we reallocated it. We did add the $1,398 and some change, 41 cents here. This is where we added the new capital on February 22nd, right? Same day we sold out of Huntington Bancshares. And what we did with those funds, a lot of buys here. Let's cover them real quick. We added 2 shares of Sibanye-Stillwater at $8.56. That's ticker SBSW. That is out of the materials sector. They are a mining company. They have really pulled back recently. There is some turmoil with their, there was a big strike they had over in Africa. This is an African company here, African mining company, and some other short-term issues that are resulting in a big pullback. So I took advantage of that. You'll see some other buys here in a moment as well. Cisco Systems, ticker CSCO. This is out of the information technology sector. We picked up 3 shares there at $49.11. This is a relatively new position, Stanley Black & Decker. I've added it over the last couple quarters. I want to try to build this one out, so we added 4 more shares, ticker SWK. This is out of the industrial sector, and we added those shares at $84.62 per share. Bank of America, one of the financial companies in the portfolio that has pulled back, and I want to build out here. This is a Warren Buffett, one of Warren Buffett's favorite. I believe it's his second largest company. So I like it, not just because he likes it, but because the payout is increasing significantly. It has a nice payout, and it's obviously a company that everyone recognizes, real good brand recognition here. So we added 4 more shares of ticker BAC out of the financial sector at $34.15. Owens Corning, another one out of the industrial sector, ticker OC, and another relatively new position I've added within the last couple of quarters, so I wanted to start building this one out as well. So we added 4 shares there at $96.81. Prudential Financial, another one still in the portfolio there out of the financial sector, ticker PRU. Added 2 more shares there at 98.03. This one's pulled back below my cost basis, so I'll add a little bit there to bring down my cost basis, increase my dividend yield, and increase potential future returns. Enbridge Inc., ticker EMB, out of the energy sector, another one that's pulled back below my cost basis. So same thing, want to add more shares, bring that cost basis down, increase the dividend yield, and increase potential future returns. This is one that I really like. It's a high payer as far as the dividend payout goes. And the only downside to this one is it is a Canadian company, so there are some tax implications there that you have to watch for a company like this. But one I like, so we added 5 more shares there at $37.56. Johnson & Johnson has continued to pull back, so we added 4 more shares there, ticker J&J, out of the healthcare sector. We added those shares at $157.72, and a lot of these companies are now below my cost basis, so we are decreasing our cost basis, we are increasing our dividend yield, and increasing those future returns every time we're able to add below the cost basis that's currently set. So we added those 4 shares at $157.72. I think my cost basis is around $163. So as long as it continues to stay below my cost basis, I'll continue to add. I am getting close to 100 shares on this. I will probably back off if I hit 100 shares, even if it stays below my cost basis, just because it's getting to be a very large portion of the portfolio. And I don't like to get too overweight in any one sector. I do like to try to remain diversified as much as possible. Union Pacific, ticker UMP. This is a railroad out of the industrial sector. Another one I want to build out here. We added 4 more shares at $190.93. Another one that's pulled back below my cost basis of around $198. So I'm hoping that this stays down here in this 190 or even lower so that I can do the same thing. I'm going to keep repeating myself here. Decrease my cost basis, increase my yield, and increase potential future returns. This is also a very fast growing dividend CAGR. The dividend growth is very fast in this one as well, so I do like that. Whirlpool, another one with very fast dividend growth, ticker WHR, out of the industrial sector. We added 4 more shares there at $140.53. Now this is just below my cost basis. I believe my cost basis is around 141. So same thing. I think it even dropped down further into the 139 range there. So I would like it to come down in that 130 range so I can build out this position as well. Same thing as J&J. If I got to 100 shares, I would probably back off this one. Now, this is, I think I mentioned on a previous video, right? I'm not perfect. So I actually did this buying on the same day that Intel announced that they were decreasing the dividend, which I had not seen yet. So I did add 12 shares to INTC on the 22nd. And you'll see again, I mentioned in the very beginning of the video, I did sell out of this. So I bought these right before I actually sold out of the entire position. So we all make mistakes. It's not how the mistakes that we make, it's how we respond whenever we do make a mistake. So we'll talk about that a little bit more, but 12 shares there. And I did not include this in the passive income added total for these shares, right? Just because I did sell out of the position. So this one, same thing, Intel, I'm not going to go into it too deep, INTC, but it is one that I pulled out of the portfolio, out of the information technology sector. I believe this is probably going to go down into the teens now with that big dividend drop. Verizon Communications, ticker VZ, like them under $40, so they dropped under 40 again. We added 8 more shares there. Verizon is out of the communications sector. Medical Properties Trust, like this one as well. This is a REIT. They deal in the healthcare sector. They've got a lot of negative news right now, so this is actually at $12.25. It pulled back significantly more later. We'll see. I added some more whenever it did. So don't be afraid whenever you see that red. In my opinion, that's whenever you're able to increase that dividend yield, right? Decrease your out exposure, right? It actually decreases your exposure a little bit whenever they pull back like that, unless the fundamentals of the company have changed, like Intel, where they dropped significantly, continue to have free cash flow problems, right? So that's a change in the business. This one doesn't necessarily have that issue. Medical Properties Trust, ticker MPW, is a REIT. We added 6 shares at $12.25. I like them under 13. They, like I said, have definitely pulled back even further than this. You'll see that here in a moment. Now, this does offset with the $1,398.41, right? The 110 we saw from the previous slide decrease. We added $155.04 in new passive income. but you'll see overall what it shakes out here in a minute. Now, this one we'll spend a little bit of time on. I do want to talk through it. Like I said, Intel did drop their dividends. So if you are a owner of Intel, you may be already aware of that. If not, know that they have decreased their dividend by about 2/3. It's a significant drop. It dropped them down below 2% dividend yield, which to me is not in line with what, unless they have a significant dividend growth. I'm not really interested in a company below 2%. Like I said, now if they're growing by 15, 20, 25%, a year, then I might consider them just to add a little bit more growth, dividend growth in the portfolio. But this one is not. They were growing around 6% before the drop, and obviously with the drop, they're no longer growing. This is a dividend growth portfolio, so we want to see at a minimum, if it's a high dividend yield, you'll see some positions in my portfolio like OHI, which is another healthcare REIT. They have not been necessarily growing their dividend that much over the last 5 years, but they are a very high dividend yield, right? Over 9%. I think my dividend yield on them is around 10%. So if I can get high dividend yield like that at 10% and they're flat, I'm fine with that so long as the dividend is safe. I consider it similar to a bond in the portfolio, right? So I don't have any bonds, so I don't mind acting like a bond in the portfolio as long as the dividend yield is high, right? If I'm not getting dividend growth or getting very slow dividend growth, the dividend yield for me would need to be over 5 or 6%. So we did sell out of our entire Intel position, $3,932.68 in capital that we reallocated across the portfolio. You'll see that here in a minute. Same thing we did whenever we sold out of Huntington Bancshares. This one, the business model has changed. They are expecting free cash flow negative for the next couple years. But the big one was, like I said, they reported out that they were looking to maintain the dividend, if not continue to grow the dividend. And then they basically went and did the opposite. So anytime a company basically lies to you, which is what they did, it should raise some red flags. So that is the reason for selling out of this one. And it did remove a significant amount of passive income from the portfolio, $227.76, because this was over 5% yield, obviously 156 shares there. So let's see what we did with those funds, the $3,932.68. And that number is wrong. It should be the $3,900 that we saw from the previous slide. So that's not exactly right there. This is the funds from Intel. But we did, with those funds from the Intel sale, $3,900 and some change, we added one more share of Verizon Communications. Like I said, anything under 40, I like it. They dropped back to 38 there. You saw we bought them earlier in the week on the 22nd at 39, so they continue to drop back. So I did add one more share, ticker VZ, out of the communications sector. Enbridge Inc., I saw them before, right? So you're going to see a lot of the same companies that I bought in the last one. We're spreading the funds out over the portfolio. I do believe in diversification. That way, if you have a company like Intel that gets into some trouble or something and you have to sell them, don't be afraid to sell a company that no longer fits your investing criteria, which Intel does not because they decreased their dividend. But then make sure that you're diversified enough that it doesn't really wreck your portfolio, which is kind of what I want to show here. So we added 6 more shares of Enbridge, ticker EMB, at $37.66, again out of the energy sector. We added a significant tranche, and I don't know why they broke it up into 2 buys. It was 34 shares here of MPW all in one buy. They broke it up into 2, but at $10.81. So again, it was at 12 something we saw before. Significant drop back. I think they even settled out at $10.66 by the end of the day after I had bought them. Again, I'm not trying to time the bottom perfectly, but I'm just buying whenever they present value or below my cost basis. And I believe my cost basis is right at $10.81. So this one wasn't necessarily below, but it was right at it. And another high yielder in the REIT sector, ticker MPW here. Sibanye-Stillwater, again, still seeing it down in the 8s, and I wanted to bring my cost basis down in this one. They've dropped significantly. My cost basis is around in the $11 range, so I wanted to bring this down. So we added 50 shares of ticker SBSW, again, a mining company out of the materials sector here. Added 10 more shares of Bank of America, ticker BAC, out of the financial sector at $33.99. Again, I like Bank of America, want to build out this position. Stanley Black & Decker, same thing. Ticker SWK, out of the industrial sector. We added 4 more shares at $84.61. So you're seeing kind of a common thread here among the companies that I spread these funds out over. Owens and Corning, same thing there. I want to continue to build this position out of the industrial sector. Ticker OC, we added them at $96.87. Very fast growing dividend yield, even though it is a lower dividend yield. It's in the 2% range, but it has a very fast dividend growth, over 20% growth in the dividend on this one. Cisco Systems added 6 more shares there. Ticker CSCO out of the information technology sector. Another 2 shares in Johnson & Johnson, ticker J&J. I'm sorry, and we added those shares of Cisco Systems at $48.78. Johnson & Johnson, again, continues to pull back at $156.38. We added 2 more shares of ticker J&J and 4 more shares of Union Pacific, ticker UMP out of the industrial sector. Passive income added was $175.88. Now, as you saw, we sold out Huntington Bank shares, we sold out of Intel. All told, the passive income removed between those 2 sales was $338.12. Now, with the 2 sales, reallocating those funds, as well as the $13.98 that we added to the portfolio, it actually resulted in a difference of negative $7.27 in passive income, right? So basically, we added $1,398 to almost remain flat in the amount of passive income that we would have had because of the drop with Intel. So I'm actually pretty happy with that result. Whenever you lose 2/3 of a dividend, a couple $100 in annual income, and you can get out of it just by dropping down $7 at the end of the day. And I feel like a lot of the companies that we spread that across are more stable and probably present better value right now. I'm fine with that. It does definitely give me a little bit more diversification across the portfolio. So I am happy with that, even though it is a negative number this week. Even though you will see the actual passive income in the portfolio did go up because several positions within the portfolio over the last couple months have increased dividends. And I usually do quarterly. I go back in and adjust the dividend payouts because a lot of times they'll announce the dividend, but it really won't hit until the next quarter. So you're going to see the increase from some companies. And the 4 companies that really I focused on was Owens and Corning. They raised their dividend by 50% back in December, but again, it really wouldn't hit until their next payout. Ticker O, Realty Income, they raised their dividend every month, so they had a 3.2% increase. Ally Bank recently had a 20% increase, and MPW had a 3.6% increase. So there are 4 positions in the portfolio that I've adjusted the dividend up to where it will pay out, either their next payout or just paid out here recently. So as I said, I do believe in diversification. I think it's important to be diversified. I have about 24, or not about, but I have 24 positions within the portfolio. So this is how it's spread out by sector, right? Communications is 9.73% of the portfolio. Consumer discretionary is 8.86. Consumer staples is 5.73. I'd like to build this one back out. I am just waiting on Procter & Gamble or Kraft Heinz to pull back a little bit to add to those positions. And Procter & Gamble did pull back a little bit this week. It's within 2%, so I may start adding to that one, even though it's a little bit above my cost basis. If it's within 2 to 3%, I'm fine with that. I'd really like it lower than my cost basis, but I don't know that it's going to get there, and I don't want to miss out on the opportunity to add to this position just because I'm a hard, fast rule of, it's got to be below. Like I said, if it's in 1 or 2%, I will add to the position. I'm fine with that. Energy is sitting at 8.29. Financials is still the largest position, even though we sold out of Huntington Bank shares. Like I said, I do want to still build out Bank of America, Ally Bank. If it pulls back a little bit more, I'll probably add a little bit more there. Prudential Financial. So I do have financial companies in there that I would like to continue building out, even though I sold out Huntington Bank shares. And that was one of the reasons. I felt like I was getting a little overweight in the financial sector, and I want to add to those companies. So I was comfortable taking I think it was around 4% gain whenever I sold out of Huntington Bank and reallocating those funds. Healthcare sitting at 8.81. This will probably get a little bit bigger if Johnson & Johnson continues to pull back. I will add to the Johnson & Johnson position. Industrials. So this one really jumped up over this last payout period here, over this last week, because obviously we added to Union Pacific, we added to Owens Corning, and we added to Stanley Black & Decker. So that definitely jumped up the industrial sector, and it will continue to grow and probably become a larger position if those continue to stay low and we add to them here over the next several weeks. Technology is sitting at 9.93. Materials is sitting at 13.13%. No utilities still, again, trying to build out some other positions within the portfolio and just have not seen the pullbacks in the utility sector, which you typically don't whenever inflation is high and the economy starts to drag a little bit. Usually utilities and energy jump up. So no utilities there, even though we are watching a couple positions for a buy-in opportunity. And REITs and real estate still remains the second largest position. Obviously, we added a significant tranche to MPW this week, and I don't mind real estate. If it pulls back, I will probably add more. OHI is another one that I'm looking at, very high dividend yield, even though it's not a growing dividend yield, very high, over 10%. So I might add a little bit there as well, even though it's a larger portion of my portfolio also. And no ETFs. I look at the overall portfolio as an ETF. Now you can pause this here and go through the actual dollar amount. So the sector weights we just ran through as far as percentage. And then here's the dollar amounts allocated. Overall portfolio sitting at $116,879.49. Big pullback over the last week here. And then in attempts to be fully transparent, I am showing you now my overall portfolio. This is how I track it in my Excel spreadsheet, right? So these are all the positions within the portfolio, the ticker, total shares, the current price as of the close of business on Friday. These will come up. These videos come out on Sunday morning, so the price will be current up to Friday at close of business. The market value currently, my average share price, right? So if you want to know how much I'm into each position, my average cost. This is that column there. The purchase price is just the average price, or I'm sorry, the purchase price is the average cost times total shares. That's what you're seeing there. Market value is total shares times current price, right? Then total return, whether I'm up or down. So you can see which ones I'm in the red, how much I'm in the red. Biggest loser right now is Verizon, right? Even though I'm down 13.9%. And this one here is down 21%. I've actually lost $1,177 on Verizon versus only $593, just because Verizon is a bigger position. And that's part of the reason I don't mind adding to Verizon when it's under 40. So my cost basis is 45. So if it's under 40, I will add to this position, and not significantly. I'm talking 2, 3, 4 shares here and there just to bring that cost basis down. Some of the other big losers in here, 11.72 down, Leggett and Platt, right down there, 778 down. And then obviously some are still up. EPD is up 300, HPQ up 200, LyondellBasell up 965. So a mixed bag, but and you can see that I'm down $1,602.74 overall, right? So that's the average losers and gainers averaged out, and it does amount to a negative 1.35% is what I'm down overall. Still beating the overall market, so I'm happy with that, even though it is in the red. The overall market's in the red by a significant amount more than what mine is. Here's the sectors, right? Each sector that they're in, quarterly, when they pay out, whether it's quarterly, monthly, or semi-annually, and how much they pay out will be found in this section. Their current dividend yield, I do adjust these every week. If the yield goes up or down, you'll see that. Yield on cost, that's my yield on cost. Portfolio weighting, that's what we saw in the previous slide. So overall by the sector, this is by each position. So if you want to know how much of the overall portfolio is in Ally or Bank of America, you can again pause this and go through here. Again, pretty well evened out. There are a couple that are a little bit higher. 8.93% of the portfolio is in LyondellBasell. J&J is 8.8. Another one that's a large position here is 6.2 for Verizon, right? So those are probably my three biggest positions. 5.94, not far behind, is ticker O. 5.09, not far behind that is Prudential. Bank of America there is 6%. So I try not to get anything too overweighted, right? I would say if it got above 10%, I would probably really back off and add to other positions. But a lot of that has to do with whether or not the company is going up in price or coming down in price. Right now, like I said, Bank of America has pulled back a little bit, so I probably will add to it. And then if it rebounds, it would jump up the percentage there. So, and then here's the estimated annual income column here. what months they pay out, and the dividend growth, right? Recent dividend growth. So again, you can go down here to the bottom and see the totals. Current market value of the overall portfolio, $116,879.49. I have $118,482.23 into the portfolio. Like I said, I am down $1,602.74, 1.35% in the negative. Current yield, this is the first time the yield actually has been higher than the yield on cost in a while. And when it's in the red, it does that. So what this basically means is that's the current dividend yield average of all the positions within. This is my yield on cost average. So with it being higher, as these companies, if I don't add to them, if they're in the red, it will automatically increase the yield on cost, right? And then whenever they flip around and turn back into green, this will be a lot higher than this. But typically, if your portfolio is in the green, your current yield will be lower than your yield on cost. This is just the portfolio weighting, showing that it equals out to 100%. And this is what the portfolio is all about. As I said, if you look at my last week's video, you'll see we were just under 6,000. This week we are a little above 6,000. All total $6,016.77 in passive income. And this is what the portfolio is all about. The dividends provided by the portfolio, the passive income provided by all the positions here within the portfolio, whether the market's up, whether the market's down. I want to see this continue to grow over time so that eventually I can live off of the dividends paid out by the portfolio, right? And as I said, the reason this went up, even though we saw a negative $7 and some change based on the changes, even though we added $13.98 into the portfolio, was because companies like Owens Corning, right? They jumped up. It was in the 30-cent range. Now it's at 52 cents. Ticker O, they had an increase in their dividend. Here, Ally had an increase recently, and MPW had a dividend increase recently. So here in another quarter, I'll do the same thing. I'll look at all these companies within the portfolio, see if any of them have raised the dividend, and I will adjust these accordingly. Or if they've lowered them. And if they've lowered them, unless it's a company like Sibanye-Stillwater or Vale, which they don't pay typically the same dividend from their semi-annual payers. So it might be a little different from one payment to the other. Sometimes one is lower or one is higher. And then a lot of times they might pay out a special dividend as well, which I don't track those or adjust the dividend based on special dividends. LyondellBasell did that last year, and I just put out the regular typical dividend payout. And this is one that actually, if you look at last week and compare it as well, it was in the 8% range. Now it's in 9%. So actually removing those two positions, Huntington Bancshares and Intel, because they were slower growers, this did increase my overall dividend CAGR. And now this is a little bit misleading because it's not weighted. So some of these that are bigger positions, right? Johnson & Johnson, for example, which is 8% of the portfolio, is growing at 6%. It is actually going to impact the portfolio more than a smaller position like Ally. Even though Ally is growing at 36.36%, it won't have as big of an impact as a company like Johnson & Johnson would. So this is just the average growth, but it is up to 9.04% average growth. Now, as some of these other positions like Whirlpool that's growing at 28% get bigger, they will impact it as well, and it may grow a little bit faster than this 9%. Currently, it probably would grow a little bit slower because a lot of the slower growers like Verizon is at 1.98%. It's a larger position of the portfolio, but it is a higher dividend yield as well. Johnson & Johnson, same thing. It's a larger position. It's only growing at 6%. Now, Bank of America is a larger position at 6.46% of the portfolio. It's growing at 10%. Same thing here. CSCO, Cisco Systems is a 6%. It's only growing at 2.7%. So it really is going to depend on how much of the portfolio portion. I just don't know how to do that math to get it weighted. I'm sure there is a way to do that based on the portfolio weighting and the dividend growth to get this more accurate. Maybe I'll talk to my wife. She's a little better at math than I am. For now, I'm just going to leave this as an average. All right, I'm rambling a little bit. Hopefully this is helpful. Like I said, I really wanted to touch on those two sales. One was Huntington Bancshares, not because it's a bad company or anything has changed, just because I have gotten a little overweight in the financial sector. I was a little bit profitable, about 4% profit there, so I wanted to book that profit and spread it out among some of the other positions. Whirlpool, I'm at 32 shares. Stanley Black & Decker only at 20. Owens & Corning 32. So these ones I want to build out. So I was comfortable spreading those funds. Union Pacific as well, 20 shares. I want to spread that out. Like I said, Procter & Gamble is another one I really would like to build out if it pulls back, but it's only up 2.67%. So I will probably, if it remains there or even pulls back a little bit more, if it's within 1 or 2%, I'm going to add to some of the smaller positions just to build them out. So that is really it for this video. Hopefully you find value in the videos. And if you do, don't forget to hit the like button, share with anyone you think might find value. Drop a comment down below. What did you do in your portfolio this week? Did you have any ads? Did you remove Intel? Or if you have Intel, let me know your thoughts on it. Are you keeping it in your portfolio? Is it becoming a drag on your portfolio? Was it a big shock that they reduced the dividend? I think some people were expecting it. And go ahead and hit that subscribe button. Join me on this journey to financial freedom and the notification bell so you are notified whenever we drop any new videos. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Drop a comment down below. Let me know what you think. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. Go ahead and put them all down below. And for those of you who have made some suggestions recently, I will get to those over this next week. Whenever I see them pull back, I'll add them to the Stock Pick of the Day series, and we will take a quick high-level view of those companies. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Hope you had a great weekend, and we will see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing journey for educational and entertainment purposes. You can lose money and should never invest any amount you're not comfortable losing. Always do your own research, invest based on your situation, circumstances, and select criteria, or seek the advice counsel of a certified financial advisor.